This program proudly brought to you by IPO Wealth for the sophisticated investor.
Hello and welcome to Money Talks, where our goal is pretty simple. We just want to make you richer. The trade war started by US President Donald Trump and made hotter by China's response has been a headwind for stocks, but it's not the only headwind. On tonight's show, let's work out whether the 3-month trade truce announced in Buenos Aires between Donald Trump and Xi Jinping will make it easy for stocks to surge, and we'll work out what else stands in the way of a Santa Claus rally and an overall big lift in Aussie stocks. We'll do that with FNArena's founder, Rudi Filapek-Vandyke, Lincoln Indicators' Elio, and later on with my hot stock picker, Belladirect's Julia Lee. Let's start with Rudi and Elio. Welcome, gents. Rudi, Elio, good to see you.
Yeah, great to be on. Thanks very much for having me, Rudi. Hope you're well.
Absolutely.
Well, it's like the old firm getting back together, mate. Look, I wanted to call this program "Don't Cry for Me, Argentina," because I thought, well, if they get it right, we won't be crying. If they got it wrong, we could have been crying today on the Aussie stock market. What do you think, Elio?
Well, look, obviously the hors d'oeuvres went down very well, I think is the best way to describe it, Pete. The good news is for everyone is that nothing will change for the next 3 months, and there's nothing more the market likes than a little bit of certainty, something that we've obviously been bereft of a little bit here in Australia. So no changes for 90 days, unlikely to be, can't promise anything. Actually, to be honest, it probably has nothing to do. It's nothing binding. All it is a little bit of a confidence kick to shake a few people out of the tree who've been sitting on quite a bit of money, because we are in volatile times. And I think it's important to reiterate, Pete, that you don't stop and pivot when it comes to volatility. It definitely usually takes a few months to play out, and this will no doubt be the same. Although that said, I think it was enough to get everyone a little bit excited about dipping the toe in, particularly as there had been quite a bit of value emerging in many different places, and the market has been looking for a reason to kick off this Santa rally, and this may very well be what we were looking for.
Okay, Rudi, you are someone who loves to think and talk outside the square.
I'm following you now.
Okay, right. Now, it was thought that the fear of Fed and interest rate rises and the trade war were the two biggest things hurting US stocks, apart from the overvaluation of the FANG stocks. If we put those three together, I think
there's two more.
Okay, throw me two more. Don't say Brexit.
No, I wasn't even thinking.
Give me two more.
A global deceleration in growth, which is taking place.
And it's kind of linked to the trade war as well.
Yes, but it is happening even when we don't have a trade war. I mean, if you look at the economic data, we had China this week again, it doesn't look flash. No. We had Europe, it definitely does not look flash in Europe. And the world is now sort of convinced that the US is slowing down as well. Slowing down doesn't mean fall off a cliff, but nevertheless,
not as good as expected.
It's slowing down. And we come from 4% GDP in the second quarter, which is probably nothing we're going to see anytime soon anymore.
Okay. So, look, I gave you 3 out of 5. All right. Now, let's just go back to it. The Fed is not worrying us about interest rates at the moment. The trade war is on hold for 3 months, and
we have a sixth.
And the valuation of FANGs have gone down.
We have a sixth one, which is the withdrawal of liquidity in the system in general, and that is a big unknown. Right?
Big unknown.
Yeah. So I would argue that this is a respite, and all the other elements are still in play, and that's why I would agree with Elio in thinking that we will have, if anything, if not downward, we will definitely have excessive volatility going forward. And we're not going to go back to the situation in 2017 when the market had the least resistance was going up and with not much volatility. I think that's over, that story. Yep. And locally, one we definitely should not forget, locally we have a deflating housing market. And there will be an effect on consumer spending from that.
Despite the fact there was no benefit on the way up. So we're the biggest.
I'm not so sure about that one.
Hang on. We had the biggest boom in Sydney and Melbourne, and people lamented retail. They lamented, and all of a sudden consumers came through in the national accounts.
The retail spending was a lot higher in the up days for the housing market than it is right now. So I would argue there has been a wealth effect.
Okay, right, yeah. What your best answer would have been, don't look at retail, because you go add retail and services, because I know even blokes like me have massages and manicures nowadays. And we didn't have that 5 years ago. Let's go to you. And don't tell people I have manicures either, Elio. Now, so from your point of view, do you think that, given all the things that Rudi quite accurately pointed out, that stocks do have a capacity to keep crawling higher over the next year or so?
Well, look, I mean, the market's always forward-looking, as they say, and it's accurately predicted 8 of the last 3 recessions. Now, for those quick enough to realise that tongue-in-cheek comment, it's just part of the parcel of being in volatile markets, that because everyone is trying to predict the future and no one actually can, you will get these periods of disconnect between price and ultimately the quality of the businesses we're invested in. Now, as far as we're concerned, look, you know, we are quite comfortable that, you know, we've seen a big sell-off from our highs back in August. So it's obvious to suggest that we're not overheated. That said, a lot of money has been flooding back into some of the quality names, and many of the growth stocks that had been sold off most aggressively during the last few months have seen quite a bit of funds flow back in, which has been great from our perspective at the Lincoln Australia Growth Fund. And actually, we've been also slowly drip feeding what had been prior to August our largest ever cash holding within the fund. So it was obvious to most that it was, even ourselves, that, you know, things were overheated. You know, markets don't move in a straight line northeast, and heaven knows when they go north-northeast they tend to go parabolic. So it's just about being prudent. But can the market continue its rise? Yes, most definitely it can. The latest AGM season was fantastic, and notwithstanding concerns over property price declines, the health of the Australian consumer still remains very robust. And in fact, I'm sort of sick of the incessant noise I hear about property corrections. I mean, I've waved many property bears goodbye over my 20 years in this industry, and I'll probably no doubt do more. And if you actually believe that the property market's in for a crash, and you're someone who is commenting on such, then sell your house and buy it back cheaper. If you're actually going to put your money where your mouth is, then you may as well do that. Not directed at you, Peter, because I know you also believe, as we do, that a price correction doesn't necessarily mean an economic collapse from our perspective. So, look, you know, definitely there's enough for us to be optimistic. Tend to agree with Rudi's comment, though. I mean, 2017 was the lowest level the VIX had ever been at in its history. Which showed that, you know, everyone really got lazy, when in fact, you know, bull markets are great opportunities to build cash pools. And the good news is if you've been doing that, you've been proactively putting it back into the market, and yeah, we think you can be comfortable continuing to do that.
Quickly, Rudi, we don't want to go to ad break. Despite all your negativity...
Well, negativity? Who's negative? I never predict the collapse in the housing market.
but who's running the show? You or
Not
me?
you.
Sounds like you.
I am.
But do you think stocks can crawl high, at least crawl higher, particularly if we get rid of... There's 3 scary men in the world. One is Donald Trump. The other is Xi Jinping. And the other is Bill Shorten.
Oh, I thought you were going to mention me now. Anyway.
Someone like you, Bill Shorten.
Exactly. Listen, here's the comment I would pick up on from Elio. And I think too many people, when giving their outlook for the year ahead, are focusing on the fact that interest rates in the US will still go higher. And then their conclusion is you buy beaten down cheap stocks that offer you a high yield. Yeah? I'm not convinced that that's the right way to go. I'm with Elio. You buy solid, reliable, high-quality companies that now also have come down just with all the rest. And those are the ones that will, in model-through scenario, or even in the worst case scenario, will, I think, will at the very least give you a good return in the years multiple ahead. Okay, so we're coming back. Julia Lee from Bell Direct will join us about her hot stock. She'll then stay with us, and we'll keep this trade truce from Trump story going. Back in a minute after the break.
Welcome back to the show. Rudi Filapek-Vandyke and Elio is staying on set, but we've also got our star stock picker, Julia Lee, joining us now with a hot stock for the week. And this time you're going to property.
Yeah, property is interesting at the moment because, look, November was a tough month for the share market and the only sector to gain ground was the property space. Yeah. It does have a yield of 4.7%, which explains some of it. But I think more importantly, certain sections of the property market, the outlook's looking relatively strong. So that's quite exciting, especially if you're an income investor and you've been hurt in the past by some of those companies that have that strong yield but can't back it up with, you know, a strong outlook.
Yeah. Now, we know house prices are having a few challenges. So obviously you're not chasing a company that's long the housing sector. So what company are you very inclined to support? Well,
really good point. The two areas that I wouldn't go near at the moment are the residential sector as well as the retail space, because AGM season's been very painful for a lot of those retailers. Yeah. And in fact, if you have a look at some of those big retailers like Myer, David Jones, even Target and the Country Road Group, they're looking to either reduce their exposure or evaluating their rents at the moment. So look, I think it's going to be tough for the retail space. I would much prefer the industrial sector where Goodman Group is, or the office space where the likes of Charter Hall and Dexus are.
Okay, so what is the company that you want to put the Julia Lee big tick of approval on?
Well, I mentioned the office space, and in particular it's Sydney that's been the most exciting. And the great thing about office buildings is that you see these rolling rent agreements. So when you see values go up and rents go up, you usually see an impact for a few years. So it's likely the very strong Sydney market that we're going to see the effects over the next couple of years. So that's great news for income investors. And look, Dexus has the biggest exposure to the Sydney office property market. Strong exposure, the outlook looks pretty bright. But if you want something a little bit more exciting with a bit more of the development options, you'd be looking at something like Charter Hall, Goodman Group.
Okay, now with a company like Dexus, what kind of yield are we talking about? Because in the age of franking credits being taken away from retirees or self-managed super funds, I guess some of these property stocks will become pretty favourable.
Absolutely. It's about 4.5%. And look, the yield is important, but so is the outlook, because traditionally when you've looked past at the performance of some of these real estate investment trusts, the performance has been huge across the best and the worst performers. It's not a huge sector, but sometimes the difference can be 30%. So actually picking the right sectors as well as the right stocks can be absolutely crucial. And I think the outlook for both the office space, exposure to Sydney, as well as to some extent Melbourne, as well as the industrial space is important. And some of that exciting growth, which can be a little bit more risky, usually comes from the development side rather than just the collecting of rents.
We love excitement when it comes to stocks, Julia. On the subject of the excitement machine, Elio in Melbourne. Elio, the stocks you like as a consequence of the Trump trade war truce?
Oh, well, look, I just want to echo Julia's sentiments there. Of that list, Charter Hall is stand away our preferred in that income space. They've also got funds management, which we like. And if you want to also just branch out in the family, Charter Hall Education Trust that they acquired off Folkestone. In regards to growth stocks, there's a stack of them. Look at many IT businesses outside of the wax stocks. So you've got stocks like Pro Medicus, healthcare equipment like Nanosonics, NAN as well. An interesting one, BlueScope. I mean, I was on the show today in my normal T20 end of day wrap, where I sort of had like 5 minutes to talk about everything I like, which I struggled with, as you can probably imagine.
Yes,
and we were talking about BlueScope, and I was actually saying, notwithstanding that its price had declined, that its price represented value. Now, it had a good bounce today. Scott Phillips from the Motley Fool disagreed, citing the company being Australia focused, but because I didn't get a reply in a 20 over game,
he watches the show.
He does. Oh, don't worry, I know he does. He's probably tweeting about it now. They're actually they've got heavy exposure in the US, and further to that, the other reason why I really like them, they maintained their earnings guidance, a strong growth of 10% expected. Mike Vasella, who is the CEO of the company, actually chose to take his short-term incentives not as cash but actually as extra shares. He had the option there, so I love someone who backs their own horse. And look, we're very comfortable, notwithstanding it is a cyclical business, but in terms of qualities, if commodity prices didn't change, which we know won't happen, so steel doesn't collapse, energy prices don't spike, because energy coming down's helped them actually in recent times. We think that there could be an opportunity there. And also look at Jumbo Interactive as well if you want another stock.
Okay.
And if you want a stock that's a great business, see to sell. You can't go wrong with that, Rudy, can you?
No, you can't actually.
Elio, you speak so quickly, one would think you're Italian. All right, let's go to you.
Okay, well, let's start with
Comment on BlueScope quickly, yes or no?
BlueScope.
Yeah.
It looks cheap.
Yeah, looks cheap. Yep,
Definitely
okay,
looks
good.
cheap. And it's true. Everyone who says it's Australian-based doesn't really know the company very well.
Okay.
But that's that is true.
Nasty.
The other thing is that, yes, I agree with CSL, by the way.
Yeah.
Coming back to Julia's subject, I'm a shareholder in Goodman Group. You remember I've been on your show years ago talking about Goodman Group, and I think that would be my favourite.
That
would be my favourite.
It was the best performer last year.
Well, exactly. That would be my favourite in that sector. Also because it hooks in with the new economy of tomorrow.
Because it provides a space for the Amazons and whatever.
Warehousing.
Yeah,
right?
exactly right.
Coming back to stocks, my preference would be for industrial stocks that are reliable, solid, high quality, and some of them, particularly in the mid-cap space, have fallen much deeper than I thought they would.
Name names, come on.
Babcock, Link Administration, ARB Corp, GUD Holdings. You will notice a couple of them are all linked to automotive sector, and they're way too cheap at the moment. I would actually make a special issue about the fact that Aristocrat Leisure is absolutely stupidly cheap at these levels. I cannot believe it has fallen by 10% after a slightly disappointing financial result, which made me go like they still grow by 34%, mind you. So I'm pretty willing to put my head on the block here and go like the share price of
You're gambling on Aristocrat.
You're feeling lucky, Rudy.
Will be higher.
Okay, that's Aristocrat. Now, Julia, you've heard all these blokes. What do you think is a really smart play?
Look, I think the upside from a trade deal between the US and China, the benefits are mostly skewed towards China. So I wouldn't actually be looking for stocks with that US exposure because, look, the US has already been performing extremely well. And to a certain extent, I think they are extremely late cycle. And I'm not sure how long you can extend out that late cycle before the animal spirits come through. So look, China, I think, is an interesting place because it's a very different cycle. And you're looking at the bottoming out of that cycle there. So whether this is a bit more of a spark to get that happening faster, I think China ETFs or exposure to emerging markets would be quite interesting. And look, they're spending a lot on stimulus at the moment. So together with that trade deal, the commodity side looks quite interesting.
So BSP and Rio still like them?
Yeah, so looking at the material space once again, especially if China is going to get out of that rut that they've been in.
Okay, BlueScope, they mentioned BlueScope. What do you think about BlueScope? It has come off a lot, hasn't it? About $18 down to about 11 or something?
Yeah, look, I think BlueScope is dependent on the spot prices that we see. And look, they have been a little bit volatile this year. So look, I'd probably steer clear of BlueScope, not because I don't like the stock, but only because I prefer seeing the commodity side, so the material side rather than the steel side, because I don't think it's going to be a massive positive for the US economy, but I think it's going to be more of a positive for the Chinese economy.
Okay, so not one of you have actually put up any real reason for people not remaining in the stock market post the Trump trade war truce. That's true, isn't it? You've been shoving stocks down our throats all night. All good stocks, and I'm proud of you all. But the bottom line is, you got to play this market carefully, but still positively.
Late cycle is exciting, but look, I would take out some insurance as well. Some of the biggest upside moves come late cycle, but you know the volatility.
Okay, but that's going for another night.
My summary would be the outcome of all the question marks and uncertainties we have doesn't have to be negative, but it can.
Yeah.
And that's why you have to be careful.
But hey, without that, we wouldn't have an exciting show like this. Imagine if it was always going up, always going down.
Well, always going up is really, really boring because nobody would have to listen to us, Peter.
Yeah,
Pete, we need half a day.
Yeah, okay, right now. Well, we'll bring you back when we start discussing what insurance we have to take out before Christmas. Okay, guys, thanks very much. After the break, Anjali Rao is going to be doing an important report on blockchain technology. Don't go away.
Coming up on Money Talks, taking the cryptic out of cryptocurrency and blockchain technology, and Investors 101 with James Mawhinney of IPO Wealth next.
This portion of Money Talks is sponsored by IPO Wealth.
Welcome back. And now for some insights into crypto and blockchain with Angela Rao and James Mawhinney from IPO Wealth.
James, excellent to have you with us today.
Thanks, Angela.
So the last decade has introduced the world to cryptocurrency, which is what brings us onto blockchain. What exactly is blockchain and why is it effectively Internet version 2?
The reason we consider it's Internet version 2, and a lot of people out there are talking about it being Internet version 2, is if you look back to what happened in the late 1990s and early 2000s, the big proliferation of development that took place when the internet came online on a mass scale created so many new opportunities. These things called websites popped up, these things called search engines popped up. There were thousands of them at one stage. As you know, in Australia there's only one that really matters, which is Google at the moment. And I say at the moment because blockchain technology may yet change that outcome. So we think it's Internet version 2 because of the opportunities that it's creating by way of employment, by way of transactional speed as well. The whole financial services space in particular is one particular area that's potentially going to see the biggest rate of change thanks to blockchain technology. And it does mean that largely the banks and the banking system, and in fact the whole monetary system, is really being questioned now because of this new technology coming online and the capabilities associated with that.
From an Australian fund manager's point of view, what's your take on cryptocurrency?
Well, personally, I hate the term cryptocurrency. Cryptocurrency had its day really back in late 2017. The market took off. These things called ICOs where it came about, these things called tokens all of a sudden came online. A lot of people, perhaps slightly less educated than the traditional investors, were pouring a lot of money into it. So a lot of retail investors were really investing and in some ways taking a punt or speculating on these things called tokens. Some made a lot of money, some lost a lot of money. The price of Bitcoin, as you've seen, it's gone up enormously. It's also come back quite substantially too. So there's a lot of speculation that took place. We like to think that the whole cryptocurrency space is not so much about the cryptocurrency itself, but the technology that it's built on, which is blockchain. And what it's affording our society is the ability to now develop technologies that create much faster transaction speed, a far greater degree of transparency, which is super important, like in the likes of the banking system. And so as this technology starts to proliferate, we see an enormous amount of investment opportunities taking place. Now, what we're finding, that said, is that there's a lot of people still thinking that this is really a speculative space. If you look at the things that are driving this, if you look at the big investment banks like Goldman Sachs, JP Morgan, Morgan Stanley, and the enormous amount of money that they're now pouring into entire floors dedicated to blockchain brokers, or technology brokers, and currency traders, you can see if the decisions are being made by these major global investment banks to invest in the space, clearly there's something to be at least looked at.
To many or even most people, cryptocurrency appears about as volatile as Vesuvius. How would you be advising investors? What should they be looking out for?
Well, for a start, a lot of cryptocurrency is actually built on speculation. That's not sustainable. What we consider is really important as an investor and an investment manager is if you're to make an investment in the digital currency space, the token itself or the investment that you're making should have some underlying asset behind it. Another really important opportunity that blockchain space is providing is the ability to have fractional ownership in assets. Now, assets could include a revenue stream, it could include part of a hotel like they have in New York at the moment. Someone's fractionalising ownership of a big hotel over there, I think to the tune of about $300 or $400 million US dollars. There's people in Australia fractionalising ownership of islands. So what's happening is it's actually opening the floodgates to enable the average person to participate in fractional ownership of something, which is really exciting. And as a result, the existing securities exchanges and stock exchanges around the world, we expect are actually going to see a lot of pressure coming up in the next 3 to 5 years, because there are going to be more securities exchanges coming online that specifically relate to trading in tokens. And we are super excited about that, being a big component of what the blockchain space is doing.
James, fascinating to get your insights on all of this. Thank you so much for being with us today.
Thanks, Angela.
Well, that's the show. Next week, we take a look at why the Aussie stock market has underperformed so badly since the GFC. And if you want daily updates, go to switzer.com.au. I'm Peter Switzer. Thanks for watching. I'll see you next week.
This program proudly brought to you by IPO Wealth for the sophisticated investor.